China's factory interest contracts in July as COVID flares up. Beijing. China's factory pastime gotten smaller all at once in July after bouncing returned from COVID-19 lockdowns the month before, as sparkling virus flare-ups and a darkening international outlook weighed on demand, a survey showed on Sunday. The Authentic Manufacturing Purchasing Managers Index (PMI) fell to 49.0 in July from 50.2 in June, underneath the 50-point mark that separates contraction from boom, the National Bureau of Statistics (NBS) mentioned. Analysts polled via had anticipated it to enhance to 50.4. The level of economic prosperity in China has fallen. The muse for recuperation still needs consolidation, NBS senior statistician Zhao Qing said in an assertion at the Bureau website. Continued contraction within the oil, coal and steel smelting industries become one of the most important elements flattening the July production PMI, he said. The studying turned into the bottom in 3 months, with subindexes for output, new orders and employment all contracting. Chinese manufacturers keep to battle with high uncooked cloth fees that are squeezing profit margins, as the export outlook remains clouded with fears of a worldwide recession. Weak demand has limited healing, Bruce Pang, chief economist and head of research at Jones Lang LaSalle NYSE, JLL Inc., stated in a Studies Observe. Q3 increase might also face extra demanding situations than expected, as healing is gradual and fragile. The authentic non-manufacturing PMI in July fell to 53.8 from 54.7 in June. The official composite PMI, which includes production and offerings, fell to 52.5 from 54.1. China's economy barely grew in the 2D area amid significant lockdowns, and pinnacle leaders recently signaled their strict zero-COVID policy would stay a top precedence. Policymakers are organized to miss their GDP target of around 5.5% for this year, country media suggested after a high-level assembly of the ruling Communist Party. Beijing's selection to drop mention of the increased target has doused hypothesis that the authorities could roll out massive stimulus measures, as they regularly have in preceding downturns. Capital Economics says that coverage restraint, along with the steady chance of extra lockdowns and susceptible patron self-assurance, is probably to make China's financial healing more drawn-out. Faltering recovery after a rebound in June, the restoration in the international's second-biggest financial system has faltered as COVID flare-ups brought about tightening curbs on pastime in a few towns, while the as-soon-as-mighty assets market lurches from crisis to disaster. Chinese manufacturers also are still wrestling with high raw material fees, which might be squeezing earnings margins, and the export outlook is being clouded by means of fears of a worldwide recession. China's southern megacity of Shenzhen has vowed to mobilize all assets to lower a slowly spreading COVID outbreak, ordering strict implementation of trying out and temperature exams, and lockdowns for COVID buildings. The port metropolis of Tianjin, home to factories related to Boeing (NYSE), BA, and Volkswagen (ETR, VOWG_P), and different regions tightened curbs this month to fight new outbreaks. According to World Economics, the lockdown measures had a few impact on 41% of Chinese groups in July, although its index of producing business enterprise self-belief rose notably from 50.2 in June to 51.7 in July.